Welcome to Entrepreneurs Rally 13, where vision meets opportunity. Join us on May 8th, 2025 at the JW Marriott Mall of America. Join 500 plus entrepreneurs for networking, learning, and mentorship experiences. Get inspired by Damon John, the FUBU founder and Shark Tank star, as he shares his journey from startup to global success. Learn from Matthew Pollard, the rapid growth guy who will revolutionize your approach to sales and marketing. Engage in our interactive sessions, including roundtable mentoring. Our action-packed day runs from morning coffee to evening reception, filled with insights and opportunities to grow your business. Why should you attend? You will walk away with practical strategies, network with industry leaders, and accelerate your business growth, all in one pivotal day. Ready to transform your entrepreneurial journey? Reserve your spot today at entrepreneursrally.org. That's entrepreneursrally.org. Thanks everybody for joining. This is EO Minnesota. This is our partners network that we're doing monthly lunch arounds. Mark Flaherty on the call today is our SAP chair, Strategic Alliance Partnership chair for EO Minnesota. And we have Husch Blackwell today, and Rob Kukulian is the managing partner, and he is going to talk about employment and tax consequences. So let's start. Mark, why don't you start us off? Give us your introduction. Tell us your role with EO and your role in real life as well.
Yeah.
And then we'll go to Rob.
Yep. For those of you who don't know me, I'm a 4-year EO Minnesota member, own a financial consulting business here in the Twin Cities with 2 other partners, and been in business for 9 years. Really enjoy EO. So much so that I thought, I better give back. So I joined the SAP chair role here this last spring. So I'll serve a 2-year term. And one thing we wanted to do was obviously bring in some new SAP Strategic Alliance partners. And Husch Blackwell has joined us here recently. It should be a great partnership. And we want to give them an opportunity to get in front of our members and share thought leadership. So we just recently started kind of lunch and learns. We're going to do these on a monthly basis. So as topics come up, this is funny because this topic had come up in our forum, and Rob actually hosted us at Husch Blackwell, and he spoke to our group, and this was a big topic of conversation. And then Jen Roth, being our president of EO this year, she was hearing this from other people, and she reached out to Rob and said, hey, I think we should do this to the broader EO Minnesota membership. So we're thankful to have Rob and a couple other partners join, and we'll be doing these on a monthly basis. And Husch Blackwell is, I would say, as a newer to the local marketplace and growing their practice across the country. So expanding here, looking to expand in the Twin Cities, and they value long-term relationships. So it makes for a great strategic partner for EO Minnesota, because we certainly enjoy building long-term relationships with other EO members and EO partners. So this is great. And they kind of view themselves as trusted partners and problem solvers for their clients, and their kind of core strategy is being expert legal counsel through a business lens, which is perfect for the members of EO Minnesota. So welcome, Rob and team from Husch Blackwell. So,
yeah, great introduction. Thanks, Mark. I don't think Rob even has to talk anymore. Rob, go ahead. Why don't you do an introduction? Tell us, tell us about yourself, your company.
Yeah, thanks so much. And good morning, everybody, and thanks for having us. I am Rob Kukulian. I am actually the office managing partner of the Husch Blackwell office here in Minneapolis. And as Mark alluded to, we are a firm with a focus here in Minnesota, but we also are a firm that has offices in other parts of the country to service our clients, in different jurisdictions and what have you. And we've been growing significantly in the last 18 months or so. Our growth is, almost 10 times. We've always experienced 10 times growth in the last 18 months. And there are a lot of reasons behind that. In a self-serving way, it's, I think, because of our approach and kind of what our focus is. And, happy to kind of follow up with anybody if anybody has any questions about that. I'm very excited to host this kind of Lunch and Learn webinar on a topic that has come up frequently from a lot of our clients, and not surprisingly, it came up from Mark and others. We were happy to kind of step up and provide some kind of background on it. And obviously the topic that we're talking about today is issues that come around the correct or incorrect classification of individuals that provide services to your company, either as employees or as contractors. And the ramifications of doing it correctly or incorrectly has a lot of effects from a regulatory standpoint, compliance standpoint, and also a tax standpoint. And there could be significant consequences if it's done incorrectly. Our experience is some of the state and other regulatory authorities are taking a closer look at kind of the practices of clients and how the clients are not clients are categorizing their service providers as employees or as contractors. So during the program this morning, we're going to try to highlight some of the key issues and considerations behind the proper classification, employees versus contractors, some recommended suggested steps and other kind of considerations, both from a labor employment standpoint, but also a tax standpoint. So to help present the topic this morning, I've asked two of our colleagues to present on this. Our first presenter is Tina Searing, who is a partner here in the Minneapolis office. Tina is a labor and employment lawyer who works closely with clients on a variety of labor employment needs, including compliance, investigations, litigation, disputes, or what have you. And then our second presenter will be Mike Dana, who is a partner in our group, represents and advises clients on a variety of these kind of tax-related issues when it comes to structuring and companies or clients' workforce, and making sure that the reporting with respect to that is done properly. So having said that, I think I will maybe turn it over to Tina to kind of start off the labor and employment aspect of the subject.
Thanks, Rob. Good morning, everybody. Rob is in charge of the slides, so I'm going to tell him next slide. So as we were talking through this, I think we hear a lot of times W-2 employees, 1099 employees, and really the language should be workers, not employees. And when we think about it, I put together this little chart of what are the key differences between W-2 and 1099 workers. And a W-2 worker can be part-time, full-time, seasonal, and can also be temporary, but a 1099 worker is very much a temporary assignment or a temporary project. It's not something where it's going to be a long-term relationship. For a W-2 worker, you as the employer have the right to direct and control the work that's being performed. For a 1099 worker, you only have the right to control the result of the work, not how the work is being performed. And that's a critical distinction that you'll need to be thinking through as you are navigating this relationship. Employers also provide the tools, the training, the equipment, and a 1099 worker is providing their own methods, tools, and equipment. And so in other words, you're thinking through like computers. Normally, the computers are being used only by the 1099 worker that they already own. Now, if you have security concerns or you need to make sure that there's a certain login requirements, the Department of Labor, the state agencies, we're going to talk about the different tests, but those are something where you can exempt out on that, but we can talk through how to best deal with that. But normally they're working in their own space and they're working in their own office and using their own equipment. For a W-2 worker, you have the right to set their hours and their schedules, and a 1099 worker really sets their own schedules. That's a point of negotiation in the contract where you can say that we need so many hours a month, which would be the best practice of what your contract says is it's how many hours a month that they'd be performing or a week that they'd be performing. And then a W-2 worker, you have the right to require that they perform no other work outside of your company. And the 1099 worker, they should be able to accept or turn down other work, including working with your competitors. And that is also one that is getting a lot of scrutiny, both here in the state of Minnesota, the Department of Labor, also in the National Labor Relations Board. So let's go, Rob, to the next slide. So I guess the slide after that, how do we figure out the classification? Well, the U.S. Department of Labor in January of 2024 came out with this new test. And this is a test that's changed from what their prior test was in 2021. And really this new test follows what the federal courts have been using to decide whether or not an individual is actually considered an employee or are they really an independent contractor. Now, what's different about this test, this 2024 test, is that all factors must be considered. Before, in 2021, the Department of Labor said we only, we can weigh the factors and look at individual factors, but not one controls. And now the Department of Labor's position is all factors must be carefully examined. So the first thing is looking at a profit or loss. If an individual, is doing a job for you and they have a set number of hours, they're supposed to do the work within 10 hours. And if they go over those 10 hours, they can't bill you for those additional, let's say they go an additional 10 hours over. That independent contractor under your agreement, if they can't bill you for that additional 10 hours, that's the loss that that independent contractor is taking. But if they have the ability to add on that additional 10 hours in the contract, the Department of Labor would say that seems more like they're working for you as an employee because they're being paid for all times worked. And if they're able to perform the work for you, and let's say it again, it's a 10-hour in a month that they need to perform this project, and they get done in 5 hours, but they can bill you for the full 10 hours, they stand to profit there. So then the Department of Labor would say that would favor that's an independent contractor relationship. The other factor that is investments by the worker and the employer. Again, that's looking at the tools, the equipment, the resources that are being made available to the individual to perform the work that is being asked for them to perform. So if the independent contractor is making the investment, they have their own, maybe they have pre-existing work that they're working off of, that they have already created some type of work product that they can use for your particular business deal that you need them to use. That's an investment that the independent contractor has made. That's standalone. That's their investment. But if it's using everything that the company has, the investments that the company has in terms of software, in terms of equipment, in terms of office space, the Department of Labor would take the position that seems to be more of an employer relationship versus an independent contractor relationship. Permanence of the work relationship. This is probably the most critical factor that we're going to be looking at, that the Department of Labor looks at, the courts look at, even though one factor is not supposed to have more weight over another. I see this as the biggest mistake that companies make, is that they seem to keep renewing the independent contractor relationship, where I've had situations where the independent contractor relationship, that individual has been with them for a year, 2 years, 3 years. I've had one where they were there for 5 years. That is a permanent working relationship, where I would say that is absolutely going to show an employment relationship, versus where they're there for a short stint, they're there for the project. Now, if you need to do a renewal for that project, that's a careful examination. We'll talk about that as a best practice. But the permanence of the relationship is one really to look at. The nature and degree of control, that's again looking at how are they performing their duties? Are they being performance managed by the company, or do they have the ability to decide how they're going to get to the product that you need them to get to? Or is there such great oversight of what they're doing by the company that would weigh in favor of an employment relationship, versus if they have the ability to decide how I get what you need done, that favors the independent contractor relationship. Whether the work is performed is integral to the business. That's an interesting factor the Department of Labor is taking as a factor for the test. I would argue that you're not hiring an independent contractor unless you think it's integral to the business for your business. So the question is it something where it's something where we needed a temporary need fix, versus this is a permanent or a long-term solution that the company needs? That factor, I don't know where the Department of Labor is going to come down on that, because that seems to be one that would be a point of contention and litigation from the employer side of things. And skill and initiative. This is one where you're hiring an independent contractor because they have a unique set of skills or business that you need for your particular business, versus is this someone where we can hire through a recruiter or someone who would fit the slot that we need for a position that's a position replacement. So that's the 2024 Department of Labor test. I will say there's a lot of litigation over this test right now, and whether or not that test is going to stay in place. Who knows if that's going to change with the new administration, but I can tell you that that's the current test that we would be operating under. So Rob, next slide. If you have employees and independent contractors in California, I put this on here. This is an important California test. This is unique from the U.S. Department of Labor, and it's the ABC test. But again, a number of courts, California courts, but also I can say Washington state courts and also Oregon state courts seem to also be following this California test. And it's an ABC test. It's a much shortened version of the Department of Labor test. But what's important is you have to have all three conditions met. You can't just have a weight of factors. You have to be able to show all three. And if you can't show all three, then the individual is automatically considered to be an employee, where the consequences for that would mean that you're going to be dealing with potential claims under the California wage and hour, what we call PAGA. So you need to look at the free from control and direction. In other words, they again have the ability to decide how they're going to perform the work for you for the company, and that they're also doing work outside of your own company, and that they engage independently, regularly, doing this type of work for other entities. So you'll need to have all three factors met. If you are thinking about independent contractors and you're in Minnesota, but you're using an independent contractor in California, just be mindful. This could be coming back to bite you in California, where it's an unforeseen consequence. So really be careful in terms of, if you're going to use an independent contractor who's in California, make sure all three of these conditions are satisfied. Next slide. And then Minnesota. Well, the 2024 legislative session did not disappoint in Minnesota, and we had a number of new things that came out, including this new test out of the Department of Labor and Industry. Effective in this year, all Minnesota employers have to meet this test, with the exception of the construction industry. And the construction industry will have a new 14-factor test effective March 2025. I didn't put that on there, but I'm happy to send it to you for those who are in the construction industry. But for all other employers, you have to examine every factor, the right of control and means and manner of performance matching kind of the Department of Labor. The mode of payment, though, is a unique one, and that's how are they getting paid. Is this one where they're getting paid by the hour? Or are they getting paid by the project? So you're going to be looking at your scope of work and your payment language in your contracts, because the mode of payment is going to be critical there with the Department of Labor. Again, the furnishing of tools and materials, the control over where the work is done, not just how it's being done, but where it's being done. So are they being required to come on site? And if so, why? You need to be able to defend that. And then the right of discharge. Is this one where under your independent contractor agreement, there's a termination provision where either party can terminate at any time, and there's maybe consequences under the contract if the independent contractor terminates early without full performance? Or is there one where the company makes the decision to terminate early and there's a consequence to the company, versus in the employment relationship, who has the right to discharge, and would there be unemployment benefits, and are there any consequences to the employment relationship for that? I will tell you in next slide, the department, as a result of this legislative session, I guess that's the wrong one, is that the Attorney General's office has now put together a commission where they're going to be looking into this, where there's a whole task force on this. So consequences if misclassified. Next slide. So again, the legislative session in Minnesota didn't disappoint, and I'm being a little facetious there and sarcastic. So effective July 1, 2024, all employers in the state of Minnesota could be subject to liability for misclassification. And I think that's really important, is that this is going to be one where, given what the Attorney General's office is doing, this will become an area of high scrutiny. And I say this because it's an area where most companies make mistakes on this. So all employers can be subject to liability for failing to classify properly the individual as an employee, for failing to report or disclose that individual as an employee under federal, state, or local law, or requiring them to enter into some type of agreement where it's misclassified. So this is one, again, where you're going to want to look at your independent contractor relationship agreements to see if there's any potential issues of that agreement in place. Are you potentially having a violation under Minnesota? Next slide. And the penalties, it's $10,000 for each individual violation, plus any damages to the affected individual. So huge penalties. And individual liability if you knowingly or repeatedly engage in this conduct. So as an individual owner, officer, or agent, you can be held individually liable as a result of this legislative session. Next slide. And then under federal law, there's huge consequences because it would be a violation of the Fair Labor Standards Act. And this would result in either the Department of Labor or private investigation or private litigation where there's an individual right of action. Again, it would be back pay and benefits, which is also a big thing that we would see. Penalties, punitive damages. Often this is where we would see class litigation and the ERISA violations. So this is one where it's an unforeseen consequence because if the individual has been misclassified and they're actually an employee, there's a failure to pay benefits that would have been owed to them if they were employees. So health insurance benefits that your company might provide, or dental or life insurance benefits, time off, vacation time. That seems to be a big one where we have a lot of negotiations where we're dealing with the benefits piece of it on the misclassification of it. And then in Minnesota, because we have the Minnesota Earned and Sick and Save Time leave now and the upcoming Paid Parental Leave Act, there would be additional violations there of those statutes. So just there's a lot of consequences if you get it wrong. So next slide. So what to do? And next slide, Rob. It's the first time I've been able to boss Rob around, by the way, everybody. So I'm enjoying this. So the best practices: do a regular audit of your contract relationships. And I would tell you to do it every 6 months. I know that sounds extreme, but anything longer than a 6-month relationship with your independent contractor should be subject to review. Use legal on this and just have it, send it to legal. I know nobody wants to pay for legal. Send it to legal and have them do a quick review of it if there's a concern on it. And I say this because you get a privilege with that, and it gives you a safe harbor when you are trying to fix it. Maybe you do find that there's an issue with that relationship and it's been in place for 5 years. You now have a safe harbor with your legal review. You have a privilege, and we can deal with it as a result of that privilege and getting that safe harbor. Once you've done it and you get the routine going, if you're doing this review every 6 months, after a year of it, you probably don't need legal as much, but there still could be a legal oversight where you can just say, hey, we just want to make sure we're flagging this. Do you see any issues with it? Always examine, are we requiring them to come on site? And if so, again, why? Or can they just do the work away? Are we requiring them to maintain hours and a schedule? If so, why? And how do we defend that? Are we requiring them to use our tools, equipment, resources? If so, why? How do we defend that? Those should be the questions you're asking. And then the big one is, are they able to work for other companies, including your competitor? You can have a non-disclosure and you can have some intellectual property agreements in place. But if you're trying to force a non-compete on them, you're going to lose in terms of trying to defend this as an independent contractor relationship. Next slide. And just next slide, Rob.
Up.
Okay. I guess we're not moving forward. So I think the big thing is just making sure. The final thing is monitor. I would put in a best practice is put in a calendar system. You bring on independent contractor, put a tickler in your system to do an automatic calendar review. And I would put it at the 5-month marker to do a calendar review by 6 months of reevaluating that to avoid any long-term relationships. And then also is determine, do we need to actually convert this person? Like the example I gave you where the person had been actually with the company for 5 years. We made the decision we had to convert them over. That's an interesting discussion. Again, I would bring legal on that one because the person may not want to be working as an independent contractor. They may have some pushback on that. But just if we examine it and we're like, this person needs to move on to as an employee, and we should be making an offer of employment, and then we can figure out how to do that. So that's the labor and employment side of things. I know Michael's going to turn it over and talk about the issues and the consequences and the tax issues of it.
Can everybody see the screen?
Yeah. Good morning, everyone. Pleasure to talk to you about this. I know everybody is always excited to talk about tax. It's everybody's single favorite topic. At least it's mine. So I think everybody should like it. Yeah. So Tina did a great job of going over a lot of the obviously the employment, labor, and employment side of the misclassification issue. As a general rule, the federal tax considerations piggyback off of the labor and employment considerations because the tax law uses the same types of factors to determine if someone's an independent contractor versus a worker. And what is the difference between an independent contractor and a worker fundamentally from a tax perspective? Independent contractors, you cut them a check, you give them their money, and they go their merry way and pay their own taxes. Unless they're, of course, potentially an independent contractor in a foreign country or something, and there's withholding requirement. We'll also talk about a little bit at the end about maybe some sales tax issues. The other issue with an employee or a worker who's really an employee of the company, the employer is required to withhold certain tax payments from the employee's checks, including income tax, the employee's portion of the employment tax, sometimes called FICA, sometimes called OASD, and the Medicare tax. Obviously, independent contractors paid all of their own taxes themselves. This issue I've seen come up, especially in where I see it come up a lot, is in the construction field, because contractors like to treat their workers as independent contractors, oftentimes because I think Tina would know more about this, but it lowers their workers' compensation costs and workers' comp insurance. I had a client that was a roofer that was trying to play this game, and he was facing, and we'll get into it, but he was facing a tax bill of somewhere around $2 million because of misclassification of workers. Can we go forward, Rob? So the big issue when an employer does not properly withhold from employee paychecks, whether it's because of misclassification or otherwise, there are a number of legal consequences for that. The first is if it's a willful failure to withhold and pay over the tax. As you can see here under my second bullet point, any person required to collect, truthfully account for, and pay over any tax imposed by this title who willfully fails to collect such tax or truthfully account for and pay over such tax, or willfully attempts in any manner to evade or defeat any such tax or the payment thereof, shall, in addition to other penalties provided by law, be liable to a penalty equal to the total amount of the tax evaded or not collected or not accounted for and paid over. You may say from the outset, you may say, well, if I'm the employer and I'm supposed to withhold it and I don't pay it and I don't pay it over, what's the big deal? Why do they have this section? Well, this section applies broader than the actual employer of record. This applies to any individual within the employer whose responsibility it is to collect, truthfully account for, and pay over tax. And this is the big hammer, thick, whatever you want to call it, that the Treasury Department can use to collect taxes that were employment taxes and income withholding taxes that were required to be withheld from employee paychecks. Generally speaking, and what they do in this situation is they look at the person is what sometimes referred to as the responsible person. If you ever start a business and request an EIN, you will see a box on there. I believe it's like box 9 or 10, and it asks for on the SS4, and it asks for who the responsible person is. And now under the new, well, somewhat, they're new for me, but they're not really new for anymore, but they still seem new to me, is there's now instructions whereby you have to have a natural person with a social security number to be reported as a responsible person on an SS4 before you can get an employee ID number. And that's because the IRS wants to track who is responsible for withholding tax. Because when the tax does not get withheld and paid, that's the person they're going to start with. They're going to look, and again, they're going to look at the person who actually has responsibility and authority to collect tax. If you have for instance, a bookkeeper or I'll call it a low-level accounts payable clerk, and their job is simply to cut checks, and they're told what checks to cut and how much, that person typically is not a responsible person. but the person who makes the decisions about which bills are paid and which bills are not paid in the company is the responsible person. That will often be, that could be a controller, a CFO, it could be the CEO, the COO, anybody with some sort of authority to direct payments from the company to third parties. Those would be your responsible parties. If a worker is not considered an independent contractor under federal tax law, but the employee classifies the worker as such, the person within as I say here, the person responsible for collecting and truthfully paying over the tax will be held personally liable for that. Every so often, the IRS will go out and audit clients for this, audit taxpayers on this point, and they will effectively request all of the same information, all the information to examine the factors that Tina laid out earlier on. You may wonder, well, how does the IRS pick up on this? Well, what they do is they run algorithms on tax returns that are filed, both income tax returns filed by employers and employment tax returns. And then what they do is they run these analyses that benchmark your return against other returns in your industry. That's why you put an NAICS code on the bottom of your income tax return, because they're going to look and see, okay, how much does this person list as deductions for independent contractors? And let's say it's, they're going to say, well, gee, most businesses of this type and this size in this geographic region are doing about $1 million. And then they look and they say, how much in terms of wages is this person supposed to be collecting? And they go through and they say, well, this person is under collecting wages. That'll trigger a misclassification on it. And so it's very important to definitely do what Tina said and examine this, because not only could you have all those other penalties that she talked about, but you can get this stick right here from the IRS. And Rob and I both know this personally not personally, but personally from a client matter we're currently working on together right now. The IRS, this is probably the number one tax. The IRS hates it when it doesn't get paid. If an employer does not collect and pay over its employment tax, the IRS thinks you're stealing their money. You're going into their pocket and taking the money. An income tax debt, well, it's your money. You're supposed to pay us. It's the liability. The IRS doesn't look at employment taxes that way. This to them is theft from the IRS. And so they are very aggressive with it, and they are very difficult to work with when there is a problem. Can we go ahead a slide, Rob? So this goes a little bit more into what a responsible person is. Obviously, this is straight from the IRS's website. It's a person or group who has duty to perform and the power to direct, collecting, accounting, and paying of trust fund taxes. The person could be an officer or employee of a corporation, a member or employee of a partnership. You can see all these people are corporate director, board of trustees of a nonprofit, a person with authority and control over funds to direct their disbursement, corporation or third-party payer, payroll service providers, responsible parties within a PSP, a payroll service provider, PEOs, and responsible parties in there, and responsible parties within a common law employer. So this is a broad universe of people. Typically, when you're looking at a particular enterprise, it's going to be about probably, I would say most small and medium-sized businesses is probably going to be 2 to 3 to 4 people in the organization that would fall within this category. Let's go ahead, another slide, Rob. So let's talk about what willfulness is. What is willfulness? So typically when we hear the term willful, we think of like a willful child, a child that just like spits in their parents' face, so to speak. That's not exactly the definition that the IRS uses. So you can see you have to be aware of the outstanding tax issue. You intentionally disregarded the law or are plainly indifferent to its requirements. One fact that they look at heavily is if you use available funds to pay other creditors when the business is unable to pay the employment taxes. That's an indication of willfulness. That's a key one, and this is something I warn clients about, particularly in the M&A space. If you have a business and you have a business that has outstanding employment tax obligations and is not necessarily paying them currently or has back obligations that they're not paying, and you acquire that business and you continue to direct business funds to other creditors other than the IRS, even if it's necessary to keep the business alive, the IRS is going to determine that you now become a willful pay or you are a responsible person who willfully failed to pay the IRS. I think it's definitely a huge point to watch out for in M&A deals. And I think, as Rob will tell you as well, because he's definitely the deal lawyer on this call, and outstanding employment tax liability is likely to kill any deal. And then again, responsibility is based on whether an individual exercised independent judgment with respect to the financial affairs of the business. An employee is not a responsible person if the employee's sole function was solely to pay the bills as directed by a superior, rather than to determine which creditors would or would not be paid. So that gives you sort of an idea of the universe of people and the situations that would give rise to it. As I said, willfulness is not really a high standard in this circumstance, and that's intentional on the government's part because, again, as I said, the government believes this is stealing their own money, stealing their money. Go forward, Rob. The other thing to be careful of is in some circumstances, in many circumstances, it technically arises to the level of a crime. It could be there are 4 main tax crimes in the code, among others, but these are the 4 main ones: the attempt to evade or defeat a tax, a willful failure to collect or pay tax, a willful failure to file a return or supply information or pay tax, and making a fraudulent statement or failure to make statement to employees. Now, because these are criminal aspects, there is a heightened intent requirement here. So it's not just sort of the willfulness standard that we saw on the last slide. It is a bit of a higher standard. But if you think about it, when you misclassify an employee, you could be, one, attempting to evade or defeat a tax, either for you or in concert with somebody else. It could be a willful failure to collect or pay a tax, and that would be obviously the withholding tax that you're supposed to collect and pay over. You potentially are willfully failing to file a return, because if you have employees, you're required to file quarterly a Form 941. And so if you're not treating any of your workers as employees and you're not filing any 941s, you potentially are willfully failing to file that return or supply information or pay the tax. And then finally, it could be a fraudulent statement if you are treating some as employees and some as not. So then you're filing a fraudulent statement with the IRS, or you're failing to make a statement to employees. And that would be a fraudulent statement, or a failure to make a statement would be by sending them a 1099 or failing to give them a W-2. All of those things could rise to the level of crimes. I will tell you, it is really, really hard to get prosecuted for tax crime. You have to do something really egregious and be a really bad actor. The example I always give is Wesley Snipes went to prison for 3 years for attempt to evade or defeat a tax. And that was largely because he was a tax protester. And it's one of those things that the IRS absolutely hates. In this situation, obviously, this is going to come up in a misclassification, is if you get a misclassification audit and you then keep doing it and you just become stubborn with the IRS, that's where you could potentially see a criminal matter arise. Let's go forward. Just some state and local considerations on this. You do have similar issues on the state level. Many states require employers also to withhold income tax and certain types of taxes from employee paychecks, and a lot of the states will follow a similar paradigm to the federal government, to the federal statutes. The other thing to be careful of is to understand what services your independent contractors are providing. And one of the things that's been happening more and more across the country is that a lot of states are looking at trying to expand sales and use tax from the traditional aspect of trying to expand sales and use tax from just being applied to product sales and apply it to certain service transactions. And so if you are treating people as independent contractors, you may want to consider whether there is some either sales and there's a sales tax exposure for the contractor, because that in some cases could have blowback on you, but more importantly, because it could cause you a use tax. And obviously, if you're performing services as an independent contractor for other people, that's also something to look at, whether your services are taxable. Generally speaking, services aren't taxable, but it is been a trend over time, particularly in the digital services area. Is something really a service? Is it really a product? You know, these lines get blurred in the digital area, and so you do have issues there. As I said towards the beginning of my presentation, if you're dealing with international independent contractors or workers, this whole paradigm gets a little bit more complicated. And then there's a whole other aspect of withholding tax that you have to deal with at the federal level. And also, you know, being careful about, application, having an employee in a foreign country. It's probably a little bit beyond what a lot of people are thinking about. But if anybody has questions about that, I'd be happy to talk more about it more in depth. I deal a lot with it, especially in my Midwestern states, my clients in my Midwestern states that are using people across the border in Canada is where it becomes an issue. So I'm going to pause there, and, I don't know if we want to move on to questions and Q&A, or Rob, if you have some concluding thoughts.
No, I think thanks so much, Tina and Mike. I think we'll just open it up for, just general questions. I think Brent, you're the one that's going to be moderating that.
Yeah, between myself, Mark, and Glinda, questions that have come in on the chats. I
can get it started, you guys. Thanks, Mike and Tina. I appreciate it. One thing that came up is I have a staffing firm, and we decided not to use since they came in and audited us. And you could tell they had a plan when they came in that they were probably going to be collecting, but they didn't consider it willful. So they just did back taxes, and they went back 3 years. I don't know if that's a question for you, Mike. Is that pretty common just to go back 3 years, or does it vary based on, the audit and what they determine is there grade levels of willful and what the company's doing?
No,
liability.
3 years is usually all they go back, because it's all they can go back under 6672 to assess the liability against the responsible party. So if they can't go back any farther than that to assess a responsible party, they usually don't. There is also a general statute of limitation on assessment that is 3 years. In the income tax category, there are ways it can go to 6 years or be unlimited, particularly in the case of fraud or non-filed return. As I said, they could go back if a company was not filing any 941s, then they could potentially go back indefinitely to do it. But then it becomes an issue of proof for the IRS and administrative burden to audit. And then also, they're not going to be able to get the responsible person for anything that was more than 3 years old. So they typically stay away from it.
I'll chime in on it also from the labor and employment side of things. The Department of Labor, there's an agency relationship with the IRS. So a lot of times when the IRS does that audit, the Department of Labor gets triggered, and they can come in and also do that same audit, and they have a 3-year look back. So it's pretty common for us to have a 3-year look back from the Department of Labor side of things too.
We've got a question from Michael, who is asking about virtual employees. What should we withhold, and how do we report for virtual employees?
Yes, that's a great question. Typically, you probably should be withholding for virtual employees in the jurisdiction in which they're actually living, which does increase the withholding burden for the employer, because now they're trying to figure out where exactly those employees are and what their requirements are. That's obviously where a payroll service provider, a PEO, is great, because a good one will know exactly what to do and would have their processes and procedures and technology set up to handle that.
Yeah, and from, again, labor employment side of things, we would look at the jurisdiction where they would be having unemployment benefits or worker comp benefits. So we'd want it to be in the jurisdiction where they're working physically.
Term, they're probably not going to have too much flexibility on terms. Do you want to read through that, and then I'll read through it and make sure there is not any major red flags set by my assumptions that will be pretty clear.
Okay, cool. Now we can maybe pick up keys today even. Okay.
You know, finalized.
I don't know if that's a question
put
for us.
Michael
I
on
think
mute?
I think that's a question for somebody else. We had a question from Mike Basinger about contract for hire employees. This is common currently with Medtronic and other companies. Also had been doing it as a trial period before new hires. How is that seen?
Let me know.
Okay.
I think there's going to be anything. I mean, it's a 6
Linda,
month.
could you put Michael on hold?
So contract to hire employees, I see a lot of companies use that. And that's, again, just making clear in the agreement itself that this would be one where it's one where right now they may be independent contractors and they're performing other work, or they may be considered temporary employees, or you're going through a staffing agency. So you have to look at that agreement of how it's really looking carefully at your agreement. And then are you requiring that contract to hire employee to be there full time, working all the services and using your resources and abiding by all your work schedule and everything? The more and more you look at that, that's really going to be what I would call a temporary employee who eventually would become maybe what a full-time employee. So you just need to think through, what's that agreement look like? Is this through a staffing agency? Best practice would be to use a staffing agency is what I would do versus doing a temp contract to hire employee where you're just hiring off of an Indeed or a recruiter. It keeps it cleaner for you.
Mark,
There's
do you have any
another
other questions?
Yeah, there's another question here about just the international and offshore employees or contractors versus someone who's working in state. Is there anything to be aware of or things you would recommend for people doing that?
So international employees, I mean, this is one where if I'm using an international employee or an international independent contractor, I will hire counsel in that country to make sure that we're not getting any mistakes in that country with their own employment rules and regulations. So, we don't really have a U.S. Department of Labor issue with independent contractors that are in another country. Instead, we may be dealing with their foreign entities with those international issues. I've had a number of situations where, in particular, France and in Mexico, where there's a lot of issues to navigate in those countries from an employment side of things with taxes and benefits. And so best practice would be to make sure you're having an international counsel in that country helping you on that.
Yeah, I would agree with that. I deal with this a ton because I do a lot of cross-border tax structuring. First of all, Tina's right. It raises all kinds of employee benefit issues. You have to remember, the U.S. is, I believe, the only country in the world that has true at-will employment, other than maybe some rather completely undeveloped countries in other places. But all across Latin America, Canada, the EU, even China, Asia, they have much stricter employment laws. The other issue that comes up is, as you start to accumulate employees in a particular foreign jurisdiction, even if they're remote employees, the question becomes whether you have a so-called permanent establishment in that jurisdiction, and such that your income can be also taxed in that jurisdiction. And that can be a nightmare. Oftentimes, just as a practice pointer, what we try to do with international workers like that is we try to structure those arrangements as much as possible as independent contractor arrangements, if we can, because it makes a lot of the income tax issues and withholding tax issues a lot less. As I said, there's a withholding tax issue that can come up if you have an employee that is primarily working from, let's say, Canada, but they're coming across the border and doing work in the US. You may actually have a withholding requirement, not as an employer with employment taxes, but you may have a requirement to withhold 30% of the income paid to that employee, because under other rules related to other withholding tax rules, not related to employment withholding. So it definitely is an area where, if you're, as Tina said, if you're going to have workers in other jurisdictions, definitely get local counsel involved. You may need a local tax tax consulting firm, because oftentimes in these jurisdictions, tax and legal is separate, unlike in the US. And you definitely want to consider whether you want that arrangement structured as an independent contractor arrangement.
Mike, does that work, including if you're working through a service? Would you say the same thing? Like, hey, that could fall back on you, some risk or liability if you're using a service that's using international, or does that not apply?
It does. If you're using a service, it depends on who. If you're using like a third-party firm, right? That's this comes up a lot in software development. You're using a third-party software development firm that's got a bunch of people in Hungary or Bulgaria doing coding for them. Then you shouldn't really have an issue if it's a domestic firm. If it's a non-US firm, then you do have all the same questions. It's just you have some of the same questions. It just has to do with whether the firm and not the individuals, whether the firm has people crossing border and effectively doing work in the US.
This brings up another question, Mike. I know there was high profile cases in the past where you're using a payroll service, they don't pay the payroll taxes, and it falls back on the employer using that service. Is there things that companies should be doing to try to mitigate those risks?
Well, I think the number one thing is to really know your providers, right? Know who your provider is, make sure they're a reputable firm, make sure they have financially stable. You know, if you go, there was one about 25 years ago that blew up, I believe in the DC metro area. I forget the name of it, and it did fall back on a lot of the folks. Now it fell back on a lot of the folks at the actual employers, and the employers had a significant liability with the IRS that they had to work out, and they tried to get contribution or insurance payouts or whatever indemnity from the PEO or the payroll service provider. But that is something you need to be careful of, and you need to just make sure you know who you're dealing with. You know, sometimes it's easy to go with some of the big ones like Paychex, ADP, or TriNet, or one of those, but it has to be balanced with going big versus getting better service.
Well, we've reached our time limit. We thank you so much, Rob, Mike, Tina. Thank you for your time. I will end on this. Joyce says this has been the best webinar on the topic that I've ever attended, including my employment law firm, what they offer. You guys have some fans here. So if anyone on the call has any other questions that they think of after this, get them to Glenda, and Glenda will get them forwarded to Rob and the team. And then we'll also include the contact information if you guys want to follow up directly with Rob and his partners over at Husch Blackwell. So thanks so much, everybody. Thanks, Rob, for coordinating this.
Yes, thank you, everybody. Have a great day.
Bye.